Hey, before we get started today, I want to talk to you a little bit about cancel culture. Cancel culture has a long list of things that it's taking away from society. It basically silenced the president on social media, has canceled most churches. The phrase "ladies and gentlemen" can't be said anymore on airplanes thanks to cancel culture. Even last week, they canceled Dr. Seuss. But you know what cancel culture hasn't canceled is the annuity salesperson. The annuity salesperson are bad actors out there still trying to sell you product that is very expensive for you. The math just doesn't add up. And for them, it's the largest payday in commissions of any product that they can sell you. We have a white paper about this at wiserinvestor.com. Scroll down to the bottom. You can see a buyer beware. Beware of the annuity salesman. Enter your email, download the white paper to learn more about why you should stay away from the bad actors out there, the annuity salesperson. Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey. How's it going?
All right, today's topic is ESG investing. It's kind of a hot topic in our industry. If you haven't heard of it before, we'll explain it to you and talk about why it's so popular. Brad, why don't you start us off with ESG, since you're our investment guru here?
ESG, environmental, social, and governance. Essentially, they're non-financial factors used by investors to identify risks and growth opportunities within companies. So they're using non-financial factors, which is unique in the history of investing to consider other things. So for investors who want to have a different look at a company relative to its annual report and its financials, they can use ESG factors to do that. Now, ESG has been around a while. It was started primarily in the early 2000s, and there's an institute out there called the Principles for Responsible Investing, started by Kofi Annan at the UN in 2005 with a group of international world leaders, and in 2006 they came out with this document, this white paper, talking about what they consider to be responsible investing.
Yeah, so it shows the investor landscape and how it's changed. In 1970, Milton Friedman, who's known for the Friedman Doctrine, actually said that the only social responsibility of companies is to maximize shareholder value. That at the time was the only responsibility was making a profit. Now it moved into socially responsible investing, where you would exclude certain funds like tobacco, alcohol, weapon stocks. And then now it's become specifically the ESG, like we said, environmental, social, and governance funds, and kind of focused on different categories within those and how you categorize them.
You know, to date, there's over $100 trillion worldwide invested in ESG, utilizing some kind of screening method for ESG.
So let's talk about E. What's the E mean in ESG? Environmental, right? So that's carbon emissions, water use, toxic waste, right? And when we look at a company. S would be social, so labor, management, health and safety, and then sourcing. So that falls under the social responsibilities of the fund. And then the G is governance, so corruption, fraud, and then anti-competitive practices. So these are all things that would be negative in the screen, right?
Yes, if a company practiced them, they would be assigned a score, and in that case, a lower score for practicing any one of those factors within the ESG pillars.
And then additionally, some funds will also exclude tobacco companies and producers of certain weapons like landmines and bioweapons. Any companies experiencing severe business controversies would also be excluded from the fund itself. So in this case, it's really the index. We talked about ETFs 2 podcasts ago, and I guess the last one too. But the index itself would screen, and then the fund just tracks the index. So you can build an index of anything these days, for the most part. So I guess the before we dive into the ETFs and how this is executed, let's talk a little bit about the rating system. So basically, every company out there is rated on what their environmental, social, and governance habits are.
Yes, the database for this has grown exponentially over the years, and the database can be created either by companies voluntarily giving this information to the rating systems, or the rating systems themselves going into annual reports, K1, Edgar, things of this nature, to draw down information, put it into the categories. And then the way they rate these is that the longer a company has been exhibiting high quality or high characteristics of ESG, the higher the rating there are. So if a company just in the last year says they are going to stop polluting, that doesn't get as high a rating as a company that has been stating it and doing it for the past 5 years. So the ratings are cumulative. But as companies move in this direction, their ratings tend to grow, but it's also relative to one another within their sector.
It's interesting to me to see there's ratings of individual companies, but then we focus on funds. So now there's ratings on funds themselves. In fact, if you want to see the rating on your ETF, you can go to etf.com/ and then type in your ticker. And there's an MSCI rating for your ETF that's there. Does this type of investing really make a difference? Or does it just make us feel better?
Well, probably both for the investor. And that's the point, is that this is an investor-driven philosophy. As investors have asked for this, the database has grown, which allows for greater selection. For those that do invest utilizing an ESG criteria, it must make them feel better in some sense that they are contributing to a value system that they believe in. Does it make a difference in the returns? That's more quantifiable, and we can talk a little bit about that. It, like any other investment, it's going to have its ups and downs throughout the different marketplace ups and downs that occur. So, but what it does do is it allows the investor to say, with my money, I have this value system, and this is how I'm going to invest. It's just another avenue for investors to participate in the capitalistic system.
So it's another screen. So it's all right. So during the financial crisis, we wanted to own large cap stocks, but we didn't want to own the financials anymore. So we took out the financials and said, here's large cap stocks, X financials, which you don't hear about anybody investing X financials anymore, right? Then we had other companies out there that have kind of come and gone. Some did it by revenue, right? It's like revenue shares. Maybe they're still around. I don't know. They're not relevant at this point. But they said, okay, we're going to sort companies instead of by their size in their industry. We're going to sort them by how much money they make, because the more money they make, then the better it is. And they go back and they back test all this data to say, look, what we have done if this fund was in existence back here. Again, none of this is necessarily human driving this, other than the human creates the index and then the ETF just tracks this philosophy. Then we had low vol, which is still around. It's still relevant. People will buy the stocks of companies that have less volatility in the overall market. So then you have this low vol portfolio for international or the world or just U.S. Then we have other strategies out there that are like quality based. So we're only going to buy companies that Dave Ramsey would be proud of. Low debt, right? High return on our investment, not our investment, but their investment into their industry. So now we have this screen. Now this screen doesn't have numerical value to it. It's more of a philosophy. We're investing in a philosophy, right? So you can quantify it, and we've done that. We've done that here, but the problem is that I see is that you're not really going to make a difference in your cause by investing in ESG. Now, some people believe that they do, that they buy an ESG fund. And I watched a webinar not too long ago, and there was a lady on there said, for our family practice, we buy all ESG, and all our clients are just satisfied to know they're making a difference in this world. Are they really making a difference buying an ESG fund? I don't think they are. I guess if you put several $billion into an ESG fund, and if you're a family that has several $1 billion, maybe you can move markets. But what's happening is you're going to buy more of the funds that have proper or higher rated ESG, and you're not buying the companies that don't. So the worst thing you can do to a company that doesn't have a good ESG ranking is what? Not move their price up as much. It makes it harder for them maybe to borrow money. It doesn't benefit the shareholders as much. I mean, these aren't IPOs. People think, I'm going to go buy McDonald's stock because I love McDonald's. They're not buying it from McDonald's.
No, they're buying it from another investor who's selling it.
Yeah, they're buying it from some other guy who says, I hate McDonald's and I'm going to sell it. So, yes, if the stock price runs up, that probably triggers executive bonuses. It does a lot of things to reward the people in the company, right? But just because you buy ESG doesn't mean your river all of a sudden is crystal clear, right? And
I don't think people expect that.
Are dirty. A lot of the clean companies are dirty. They're just dirty somewhere else. They're just not dirty here.
That does bring up an interesting point, Casey, in that the ratings around ESG are not 0 to 100. Okay.
Right.
Okay. Every company is somewhere in between. That nobody has a 0 and no company has a 100 rating. So what they're doing is on these screens is saying who has the higher rating than the industry itself or the sector itself. And then they rank them within the sector as well. So what I think that ESG investors are trying to do, and I really have not tested those waters as an investor myself, but what I think they're trying to do is saying if I can get enough people like me to invest in this, I may have the opportunity to influence a proxy vote. I may have the opportunity to influence the board of directors. Okay. And if I'm a board of trustees looking at managing a pool of money, such as an endowment, I may want to make sure that I remain a board of trustee because if I'm representing a larger pool of people who contributed to these assets feel that way, I need to move in that direction as well. So I think it's an ends to a means, but during that time, does the individual make a difference? No, but in conglomerate, there is an opportunity to make a difference. But whether or not they can through influence and activism, remains to be seen.
We know in Europe that this has already been set by the government. That the companies have to behave in a certain way.
Well, they're mandated by law
on ESG.
Yeah, investors, in fact, in some instances, are mandated that they must disclose how they vote proxy.
Right. So, people that come in, not clients, but wholesalers that come in and say, you got to buy the ESG because it's on the forefront. And Europe's a way ahead of us, and I hate that. I hate it when they say that. They're not ahead of us. They're just different than us, right?
This is a trendy marketing term is what this is right now, is they're using that to advance whatever, like you said, wholesaler, advance some type of fund or the industry. You look at, we've talked about companies like Delta, where they're some so-called carbon neutral. just because they were planting a bunch of plants and trees in order to offset their emissions. So I think it's really important to actually see what the company is and what the data is to support that it is an ESG fund and not just a term they're using to categorize it that way.
Well, there's an article. We're going to cover this tomorrow on our YouTube channel. But there's an article already that the SEC is investigating financial advisors and companies of products that are saying that they're ESG friendly, because it's this catchphrase. Everyone wants to be ESG, but there's no regulation behind it, meaning from a marketing standpoint. So you could be buying something in ESG and, it has nothing to do with ESG really, or it did slightly, or they didn't print off the paper to show you the pro forma. They emailed it to you, and now it's an ESG friendly company.
Right. And the rating systems themselves, to your points, if they're all different, then it behooves the investor to understand which rating system is being used to evaluate that investment.
Right. You could have a great rated company on one side, and then maybe it's middle of the road on the other based on the evaluation.
Right.
It's the same way with home building. You had LEED certified, but then you had all these other certifications for a green home, and they were never quite in sync. Thank you for being a loyal listener of the Wiser Roundtable. In our weekly meeting this week, our marketing brand manager, Dana, came in with some great news that we are in a top 700 spot of podcast right now. And I didn't realize this, there's over 400,000 podcasts out there that people can listen to. And thanks for choosing us. To help us even grow more, I'd like to ask you for a favor. If you could go on and review us or give us a 5-star rating on iTunes, Spotify, Google, Stitcher, or however you're listening to this podcast, we would appreciate it. Again, thanks for listening. We have a great time putting this together each week, and hope you enjoy this episode. But yeah, I don't know that if you buy ESG, here's my fear. I'm an indexer. I want to own the core, large, mid, small, foreign, core bond, even though we break that out now because you don't want to own core necessarily right this instant. But I'm a core indexer, so I'm not trying to bet on value. I'm not trying to bet on growth. I just want the S&P's average 8+% rate of return, 12% plus on some years, time periods, I should say, depending on how you look at it. I want that rate of return over my lifetime. So if I've got 40, 50 years to go, I want to get that average, because 99% of stock pickers and index creators can't beat the average over a long time period, right? So when I see something new come out, my antenna goes up going, I don't know. I don't know. Here's what I'm trying to get to is, if we're all moving to ESG as a society, and maybe that's good for society, that's not what this podcast is about. But assuming that it is, all these S&P 500 companies are going to be moving that direction as well. So right now I'm paying 3 basis points, that's 0.03% for my ETF, and it trades for free. I'm not paying anything to invest the portfolio, right? Then it comes along BlackRock. We're going to save the world. So BlackRock comes and says, hey, ESG, we're forcing it down your throat. Everything's going to be ESG. All of our models are going to be ESG. And how I see it is they are profiting from ESG, because now all of a sudden my S&P 500 index fund, which is 0.03%, right, has 500 of the best companies in the world in it. Now all of a sudden, for the same large cap exposure, I'm paying 0.15%. That's a huge increase percentage wise. If I want to add mid caps to that, I'm going to pay 0.25%, 1/4%. Now you want to now you say, Casey, that's not that big a deal. You want to compound that over the rest of my life. That's a lot of money, right? So that's my fear, is they're coming in with a new marketing scheme. Larry Fink at BlackRock, he knows this. He's a smart guy. He goes, I'm going to make billions off of individual investors off of this ESG platform. So he rolls this out. He shoves it down everyone's throat saying, hey, we're going to offer these products. And people, these same companies that have these ESG ratings. And let me go back a second. The ESG ranking for the S&P 500 value stocks is an A. The ESG ranking for large cap in the BlackRock ESGU, right?
ESGU,
ESGU, yes, is an A. It's the same ranking. Huge price difference, right? In the S&P versus that. Now the growth stocks are triple B, which is one notch below. And, so the S&P as a whole is a triple B ranking. You used the numerical value earlier.
I saw a numerical value where the ESGU, I think, was ranked at a 5.9 out of 10 versus the S&P 500 being a 5.3 out of 10.
It's almost the same, except if they push ESGU, they get a premium. Now, to counteract that, ESGU had a better performance than the S&P 500 over the last 12 months. It outperformed it by 5 percentage points. 5 points. And we have gone through and we've looked at the style. We've looked at the sector breakdown of ESGU and S&P 500. And honestly, the 5% probably comes from companies that have a higher ESGU ranking. However, there's more to the story. So let's talk about Tesla for a second. So Tesla got added to the S&P late last year, like very late.
Very late, yeah.
And Tesla had a, 800% increase last year? It was a very big increase.
Huge year.
So that moves things when you have an 800% rate of return on a large market cap company like that, right? So Tesla was not added to the S&P. The S&P is chosen by a committee. They have rules, right? Then what happens, Vanguard's large cap, VV, large cap index fund, they added Tesla a long time ago to that large cap fund.
I mean, they're one of the largest 5 companies in the whole world, and they weren't in that fund.
Right. So they added it very early. VV and IVV, similar tickers, not related, right? IVV is the BlackRock S&P 500 index fund. VV is the Vanguard large cap fund, not related to the S&P whatsoever, although it does have a lot of the same companies.
Many of the same. But the S&P has a profitability screen, which Tesla didn't meet, so it didn't wasn't applied into it until late November, early December timeframe.
That's right.
Right. That was just a market cap they were going off of. That was so
correct.
large.
But
VV.
if you added Tesla, well, you did. Tesla's in VV. VV outperformed IVV. The Vanguard outperformed the BlackRock S&P by 2 percentage points, simply because of Tesla. That's really the only reason. So if you apply that to ESGU, where ESGU, I don't know when they applied Tesla. I don't know. We'd have to call them to figure that out. But my point is that it wasn't just because of ESG or ESG fund companies that it outperformed. A lot of it just has to do with this construction of how companies get in there to begin with. So Tesla was already part of it. Now that 5% difference is really maybe only 3% related. Now that everything's been trued up after December 31st with Tesla and some other companies, S&P, and it's early in the year, but the S&P is outperforming ESGU currently by a very small margin, about 1%. So point is, if I'm an ESG fanatic, maybe I feel better because I have ESG in my portfolio, but really all you're doing is falling to a marketing plan. Potentially, you're falling to a marketing plan, and it's costing you more money in the long term. Not saying that as a fact, but that's just how I view it right now. I mean, our job is to protect the investor. That's what our job is. and we can't jump on every flashy object that comes down the marketing funnel of these large companies.
No, we can't, because these large companies that sponsor ETFs, like you said earlier, Casey, you can make an index out of any idea that you want anymore with aided, especially artificial intelligence and computers. So we're inundated with new ideas as investment professionals on a daily basis. And it is important that we do our own due diligence and we do our own screening to see whether or not these are really good, long-term, healthy asset classes, as we say around here, for our investors' portfolios.
You mentioned BlackRock. I mean, that's one of the largest asset managers in the world. They're big enough to where they can move the needle just by marketing ESG or whatever the new thing is. Just by marketing that, they can move the needle on what momentum stocks are within that.
And BlackRock also just got a spot in the White House, which I thought was very interesting. Right? I mean, the White House on economic policy, and it's always been what, Goldman or J.P. Morgan. Those are the companies that get someone in the White House. But after all these moves, I noticed that BlackRock had a position there this time. So, again,
maybe there's even more reasons for ESG that we haven't considered.
Right. Exactly. So I don't know. I just, we went into the low vol thing during the financial crisis. Low vol became more volatile than the actual S&P 500 for about 12 months there. So you just have to be careful with the marketing and what really works. We know it works. We know it works 99% of the time, and that's holding the core, right? That's why my pick of the year was VTI, the entire U.S. stock market, because is that going to get beat? It's going to get beat by a lot of things, but will it be beat over your lifetime? No. Statistically, it's never happened, right? But you have to have patience and good behavior, right? You can't sell in panics, and you can't be buying in and out all the time. Try to time it. It's more of a buy and hold approach, but. We just have to be careful. Should we be better with the environment? Yes.
I think everybody thinks so.
Should we be responsible? Should we be inclusive in our board and with our employees? Absolutely. Those are all good things. But does it mean it has to be in your portfolio? I don't think so. I don't think so, because it's in your portfolio already. It just doesn't have that wrapper, right?
And I think that's key. These companies are all moving in a direction to imitate society in some sense, okay? Because it's just made up of people. A company is just people, okay? So as people are going through the company, their value systems being left there and being included there.
I mean, you talk about the S&P 500, you always tell me, well, if you own the S&P 500, you always have the winners, because the winners always sort to the top. That's why ExxonMobil is no longer the largest holding of the S&P 500, right? It's
right
down near the bottom now, right? So if all the winners float to the top, that means that if ESG is the way to profitability for these companies, every single company is going to be doing it. There's not one single company out there who's going, yeah, no, that's not for us.
It's a little easier for the tech companies to do that than the energy companies, though, to your point of what's the top and what's the bottom of the funds.
Yeah, possibly. I mean, tech's high ranking in every index. It's market cap rated, so it looks very. That's why the ESGU and IVV look very similar for the top holdings. I would argue that if you have an oil company and it's spewing oil into the ocean, you can physically see it. We are polluting the ocean. See, right? But if you have a server room occupying a small town and it's run off a coal plant somewhere, well, the company itself is clean, but not the energy that it's bringing in. It's just dirty somewhere else. This is what a point I made to earlier. So, how do you handle that? We talked about Bitcoin. Right? I mean, Bitcoin wouldn't be representative in any of these funds, but, well, maybe Tesla, right? $1.5 billion in Bitcoin purchase they've already made $1 billion on, right?
Yeah, if you invest in a company, you invest in everything.
Mining Bitcoin is 1.5% of the world's energy. It takes more energy, or it takes less energy to power the country of Ukraine than it does to mine Bitcoin around the world. But again, yeah, it's probably
to your
not
point. You don't see it.
Right? You don't see it. It's not in your
Right.
backyard. You can't point to it and go, "Oh, that's Bitcoin mining. Someone's mining Bitcoin in my neighborhood again. I can see it in the street." So yeah, it's the same way with the batteries. We have all these batteries for these electric cars we're making. Well, my gosh, have we seen the damage and destruction that it takes to get lithium batteries? No one talks about that because that's not here. That's somewhere else. So the inability of people to think all the way through point A, B, and C. So I think all we're saying today is, it's great to be pro-environment, but when it comes to your portfolio, don't fall for the gimmick because it's going to cost you more in the end. Now we'll know the next 3-4 years performance-wise if it all pans out. My feeling on it is it all comes back down to the average in the long term, that the S&P will not be outperformed by ESG stocks. But that's my opinion. I don't have any basis for that right now because we have very little data, long-term data on ESG. I'm very passionate about this topic, guys.
It's a great topic. It's not going away. I love your point that in 3 to 5 years we'll know more. If everything qualifies for ESG in 3 to 5 years, will there still be ESG?
Is the S&P the ESG fund?
No, because there'll still be 1% of companies that didn't get it, or 2% of companies that didn't get it. They'll probably show up in the S&P somewhere. But yeah, I don't know. Maybe those ESG funds will become 3 basis points, just like my S&P 500 fund, right?
Then we're all in.
Then we're all in. Will they merge the funds at that time? Will that just be a fund merge, or they have to shut one down? I have so many questions.
Yeah.
One thing's for sure is BlackRock and all the other companies that are following in this, they're going to get rich over the whole concept, because that's the direction that we run in herds, unfortunately, and even us out here as independents, we're not going to be able to sway the mass public, I don't think. All right, guys, good conversation. Looking forward to the next one.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.